Hi, everyone. My name is Alex Rashears, and I'm a private lender. I wanted to spend a little bit of time today talking about what private lending actually is on a broad basis and just give you a little bit of background on the ways that you could possibly be involved in private lending if it's something that resonates with you. So, you might be new to real estate. Maybe you're seeking some sort of alternative way of investing, something outside of the traditional investments like stocks, bonds, mutual funds, or you're possibly an active investor. You're looking to boost some cash flow or just maybe kind of separate yourself and kind of quietly retire from managing rentals or maybe even short term rentals. Whatever the reason for investigating private lending, I just want to welcome you. And also feel free to join the community on Facebook, Private Lending Lessons, if you want to see more educational posts, network, and videos about private lending. So without further ado, let's get started. So most people want the passive income, some level of income from real estate. If you talk to the majority of people that are at a RIA meeting or maybe a virtual meetup, they're going to say why they got involved in real estate. And it's probably going to focus around some level of want to have income, want to leave my W-2, wanted to be able to do what I want, when I want, where I want, with who I want. And a lot of that requires money. So how I kind of break into private lending or talk to people about private lending is, do you want $2,000 a month deposited in your bank account? Like, who's going to say no to that, right? So here's a couple different ways you could end up with $2,000 a month deposited in your bank account. So you could have $200,000 loan out at 12% paid monthly. So you could have a $184,000 loan that's going to be 13% annualized interest, again, paid monthly. It's going to be about $2,000. Or you could borrow $150,000 at say 6% and have $125,000 in cash, lend out both at 12%, and you get paid roughly $2,000 a month. So as you can see in just this one slide, there's a couple different ways you could structure things to get the income that you're looking for. So as we dive into more of the details in future slides, you'll kind of see what those differences are, but the possibility is there. And you can also invest in private lending through a retirement account. So won't necessarily get the today benefits of that passive income, but if you're someone that likes to see your retirement account balance continuously go up instead of riding a roller coaster of stocks and bonds, then this might be an option for your retirement account as well. So like I mentioned, monthly income is kind of the name of the game for private lending. It is a pure cash flow play. And what's really funny is I talk to a lot of investors and their goal is $10,000 a month in income. You know, that's what they want to make, is $10,000 a month in income. And they tend to think they need to have, 20 doors, 50 doors, whatever it is in terms of rentals, but they don't ever think about other ways that they could possibly get to that $10,000 a month. So for example, you could have $1 million out at a 12% annualized rate, and that would be $10,000 a month. Yes, roughly there's going to be some taxes in there. There might potentially be some downtime where loans have been paid back and they're waiting to be deployed. I'm trying to keep this super simple. The other thing is, like you saw in the previous slide, you can also borrow money and then make money from the difference in the interest rate. It's called the delta, different interest rate. So you could have 2 million borrowed at 6% and then lend it out at 12% and still get your $10,000 a month. So the complexity only goes up from here. So I'm trying to keep it super simple, but just gives you a sneak peek at what some of the possibilities might be. So why do I like private lending so much? It is personally because it fits within my lifestyle. It's not just an income. I can go do a wide variety of real estate things, a wide variety of investing, but those might not necessarily suit my lifestyle or my personality. It's a matter of, what do I physically want to spend my time doing? I don't enjoy having long-term rentals. Does that mean they're a bad way of investing? Absolutely not. But they don't fit with my personality. They don't fit with my goals. They don't fit in my lifestyle, whereas private lending does. So I'm going to encourage you probably multiple times throughout this talk to really think about not only how great private lending could be, but also, does this actually fit into my lifestyle and my goals? And there might be a chance it doesn't, and that's okay. Now, just a teeny weeny bit about me. So why should you listen to me? I am one of the authors of Bigger Pockets, Lend to Live. It's got 15 words after that. but it's a how-to manual for private lending. And I've spoken at multiple national real estate conferences. I'm an active member of the American Association of Private Lenders. I've been on their education committee. I've served on their government relations committee, and I won the Community Impact Award in 2002 or 2022 for private lending. I'm a community leader, like I mentioned earlier. I run a free educational Facebook group called Private Lending Lessons as a place for both active investors and private lenders to come together and learn more about private lending and private lending safely. And I'm also an active private lender. I lend out my own capital and that within my network. So this is something I'm actually doing, not just marketing on how to do it. Now, just to give you a little bit of framework, I'm going to assume some people have a little bit of knowledge about real estate. If you don't, and this is very confusing, feel free to shoot me a message. But what most people don't think about in a real estate transaction is who's getting paid and under what priority. So for example, a lot of people will mention the term capital stack. If you're not familiar with that term, it's basically if something hits the fan, I won't say the bad word, but if something hits the fan, who gets paid first? And in reality, the lower you are on the capital stack, that means the more priority, the more seniority you have to claim to the money from that particular asset. So for example, in private lending, if you're lending as a first lien holder, that first mortgage, you're at the very bottom of the capital stack, which is where you want to be because that is going to be the most secured. Should something happen to that property, should something happen to that deal, you have first claim to the property and potentially what it would sell for at an auction. For example, if you've ever heard about buying property on the courthouse steps, that's this process happening. Then next would be obviously a second mortgage, and then actually comes owner equity. So if you are equity investing, for example, if you own a property, whether it's long-term rental, short-term rental, maybe you're involved in a syndication of a multifamily or self-storage, whatever it happens to be, you are actually at the top of the capital stack. That is the owner equity portion. So that means should something happen to that deal and that property has to be foreclosed on, that means that is the group of people that are going to get paid back last. So if the first mortgage gets fully satisfied, anything above and beyond that would then go to a second mortgage if there is a second mortgage on the property. And then it would go into owner equity. Potentially owner equity in some of these larger deals kind of gets fractured out to things like preferred equity. So really that equity part can go even higher than what it's pictured here. But just to kind of give you an idea of the difference between doing something like private lending versus something like investing in a syndication for a larger asset like a multifamily building, it might sound pretty similar. You know, the amount of money you need might sound pretty similar, but just understanding where you are in that capital stack, it can provide a nice diversification if you are already heavily invested on the equity side of real estate. This might provide some sort of diversification without necessarily leaving the real estate space. So where does private lending kind of fit in? You know, everybody's very familiar with going to their bank, applying for a mortgage, maybe talking to some of the lenders you see advertised online or referred to from a friend. So where does private lending fit in that whole sphere of things? Private lending tends to be quicker closings. So if you've ever had to get a mortgage from a bank, you know it wasn't a very fast process. So generally, a lot of private lenders can usually close in under a week. Sometimes it can be a couple of days. It just depends on where things are in the process. Underwriting tends to be a lot less intensive. So again, if you've ever bought your own home, you remember how much paperwork and how many questions that they asked. Underwriting for private lending tends to be a lot lighter, especially when you're comparing it to conforming loans. Some private lenders don't even check credit. So just to give you an idea. Usually private loans are going to be a shorter term, so think months instead of years. So these loans are meant to be very short-term debt. Why would an investor want to take on such a short-term debt? Is generally because they need to close quickly on the property. Maybe they want to give a cash offer to be a little bit more competitive with their offer when they're out shopping for property. A lot of times the property isn't necessarily habitable. So it's not in a condition that a permanent financing provider like your bank would be willing to finance that property. Maybe it needs significant renovations, maybe it had fire damage, maybe it had some water damage, whatever the case might happen to be, the property is not habitable, a bank will not lend on it. So we come in and provide that sort of financing for the borrower to get the property up and renovated and potentially rented or sold. Usually there's a balloon payment at the end. If you're familiar with buying your own home, you more than likely have what's called an amortized mortgage. So they are paying interest and principal in kind of a declining amount for interest and increasing amount for principal over the life of the loan. Since these loans are such a short period of time, we do interest only payments. So like you saw in this first couple slides, if you are lending out on an interest only basis, your payments are going to be some percentage of that loan amount is going to be coming in on a monthly basis. For rough napkin math, what I'll say is usually about 1% of the loan amount is going to be coming to you as a monthly payment, and we'll talk about how that happens. Also, these loans are what's termed business purpose loans. It might be on a single family home, it might be on a duplex, it might actually be on a commercial property, but they're considered business purpose loans. So you're going to have a business as your borrower more often than not. Could be an LLC, could be an S Corp, doesn't matter, but it's generally not going to be a single human being as an individual. It's going to be a business. And then everybody likes to know, how much am I actually going to make? What's the process? So private lending as a whole can be very wide open. I know private lenders that will lend kind of all over the spectrum. Some are very specific on what they do. So I'm just giving you kind of my basis of what I know in the industry from people that I know that are doing this. So origination points are points that are paid. Usually it's a percentage of the loan amount that are paid upfront at closing. Some private lenders will actually kick this to the end and roll it into their payoff. One of the great things, and also potentially one of the downfalls of private lending, is how flexible it can be. So I can tell you generally what's done, but that's not what's going to be done in every single case. Fees are generally going to be anywhere from, potentially a couple $100 to a couple $1,000. These fees are generally going to be things like an underwriting fee, a processing fee, a document prep fee, maybe a wire fee for the charges you're going to receive for wiring money back and forth out of the bank account. We try to keep the fees pretty reasonable. Generally, it's just going to cover what our costs are for the loan, things like document prep, the appraisal, whatever you're going to use to value the property. But generally, like I said, they're going to be anywhere from a couple hundred to a couple thousand, depending on what the loan is and what it's going to be covering. The annualized interest rate for a first lien loan, first mortgage loan, generally is going to be anywhere between about 10% and 14%. That doesn't tend to flex too much with the Fed raising rates. I know that's been a big topic of discussion lately. So if the Fed can raise things and lower things as much as they want, private lending tends to not be tied to whatever's going on in the rest of the interest rate world. So I would say as a whole, for a long period of time, between 10 and 14% as an annualized interest rate is pretty typical for a first lien loan. One of the other things that we require is what's called a personal guarantee. So like you heard me talk about on the previous slide, you're going to have a business borrower. So that's going to reinforce that we're going to have a business purpose loan, which is where we want to be for investment property. So your personal guarantee is actually going and saying, okay, it's secured against this piece of property. The borrower is actually the business entity. So if this property were to get foreclosed on and there's a deficiency, so it doesn't sell at the courthouse steps to make you whole, theoretically, you have the ability to then go after the LLC for any deficiency in that amount. And then if the LLC doesn't have any assets, you can then go after the individual with their personal guarantee to go after individual assets. So we always require a personal guarantee, understanding that that personal guarantee is really our third line of defense for being made whole. So first, it's going to be the property. Second, it's going to be the LLC or company buyer, corporate buyer. And then third is going to be the actual personal assets of the borrower themselves. Loan terms, like I mentioned, anywhere between usually about 6 months to 12 months is typical. Sometimes it goes a little longer to 18 months if there's going to be significant renovation, or maybe it's a ground up construction that's already been permitted, et cetera. Some active investors actually will build a pool of private lenders that are kind of from their network, and they'll actually use the capital from 3 to 7 years. And obviously, they're going to be paying a little bit less than the 14%. But what they'll do is they'll use that private capital to fund a rental. And then they'll just have this rental in their rental portfolio. The renter will pay rent, and then it goes back out the door in terms of a mortgage payment to the private lender. So just because the average or the typical is 6 to 12 months doesn't mean you're held to 6 to 12 months. You can absolutely do anything that's within the scope of the law from 6 months on forward. I wouldn't necessarily do anything shorter than 6 months. It just enters a different kind of business model. But loan term can be absolutely anything you want it to be. But I will say generally it's between 6 and 18 months. Lien position, you might have heard me mention that. That's going to be first mortgage versus second mortgage versus anything else that's above that. This talk is going to primarily talk about being in the first lien position. So you're going to be the first mortgage. You're not going to be a second mortgage on anything. You are not going to have an unsecured loan. So you're not just having a borrower sign a promissory note. You're actually going to have a deed of trust or a mortgage, depending on the state you're lending in, actually recorded at the municipality where the property is located. So the entire public knows that this property has a lien on it and that it must be satisfied in order for it to change hands or be refinanced. The loan to value, if you're familiar with real estate, you're probably very familiar with this term, but it generally means that it's the loan amount divided by what you perceive the value of that property to be. Most private lenders are going to stick to maybe about 75% loan to value or less. There's a couple different reasons we can talk about that for risk mitigation, but generally you're going to want to stick to about 75% loan to value or less. And then the last thing I want to talk about is construction holdbacks, because you heard me talking a few slides ago about the process of buying these properties. They might not be habitable, right? So if for some reason they are not habitable or they need significant renovation, private lenders can hold back a portion of that loan for construction and renovation cost, as long as it's below, again, that 75% loan to value. So the borrower is not leaving closing with a $30,000 check to just go and spend wherever they want, and you're just keeping your fingers crossed it actually goes into the property for supplies and labor. So there is a process where you can do a construction holdback, and then they will have to submit receipts or work orders, whatever your process happens to be. If you're new to private lending, I would say give it a few loans before you're trying to do construction holdbacks. Or if you're lending to someone that's in your network, you know really well, and you have faith they're going to manage the money, go by all means, that's your risk tolerance. But I would say do your first couple loans, potentially without the construction holdback portion, just so you're going to be building a little bit of muscle memory. There's going to be a lot of moving parts. It might be feeling overwhelming at some point. Not saying don't do it, just saying that's one less thing to worry about if you don't have to deal with construction holdbacks. Sorry, getting over a cold. Now, people always ask about risk. Fair question, right? It's an investment. There are downsides. There's always going to be some opportunity, some level of risk for this. Doesn't matter how you're investing, private lending is no different. So ways we can minimize or mitigate our risk are here. First off, like I mentioned, you're going to have a secured lien that's recorded in public records, mortgage or deed of trust. I would 100% have all of your documents drawn up by an attorney that is familiar with lending in the state the property is located in, because each state is going to be different. They potentially have different state disclosures, different requirements for how those securitization instruments need to look, formatting, whole 9 yards. Just have someone who's knowledgeable in it. That is the most important aspect to doing any loan, is making sure the paperwork is correct and legal. The next thing we're going to talk about is hazard insurance. So as you're probably familiar, you have hazard insurance on your own home if you own your home. Hazard insurance also protects the lender. So you're actually going to be added as a loss payee mortgagee on the hazard insurance. That way, if there's a claim made, if the policy is canceled, the policy ends up being denied or changed in some very big way, you're going to get notified that that policy is changed or been canceled. Also, if there is a claim, property catches fire, they're actually going to, and obviously inform you a claim has been made and potentially secure funding to either fix the property or pay off that loan. And then the borrower can kind of do what they want with the shell, depending on how bad the damage is. But the big thing is being added as a loss paid mortgagee gives you the right and the insight to know what's going on with that policy. Title insurance is also 100% a requirement. If you've bought your home, you might be familiar with title insurance. Generally, it's required across all lenders that you are going to pay, the borrower is going to pay for a title policy, a lender's title policy. There's also owner's title insurance that can be simultaneously issued at the time a lender's title policy is done. Usually it's a couple $100 extra at most. So I usually advocate borrowers also get an owner's title policy. I don't make it mandatory, but they are required to have a lender's title policy. The loan to value evaluation, like we talked about, you want to make sure the value is there on that property and that you're not going above 75% of whatever you perceive that value to be. There's a lot of different ways that you can do that valuation. Really depends on your experience, your background in real estate, what you have access to, what your comfort level is. You could do anything from ordering a full appraisal. That's probably going to be the most time intensive and the most expensive, but if that's what you're comfortable with, then do that. All the way down to potentially, if you wanted to, pulling free resources. Things like Zillow or Redfin will often have the ability to kind of search comps within a certain area. And then you can also do something like a subscription service, desktop appraisal, have a real estate agent kind of pull a CMA for you. There's a lot of different options for making sure you understand what that value of that property is. Again, we talked about the construction holdback agreement. If you have construction holdbacks, having a really solid foundation of what the process is going to look like, how quickly you can turn around those funds, how they're going to get the funds, how frequently can they request funds, all of that will be outlined in your construction holdback agreement. And then lastly, promissory note. This is going to be part of your loan documentation. You're going to have an attorney draw up for your transaction, for that specific transaction. And that promissory note is going to outline all the terms of the loan, how they pay, the interest rate, default rate, when they're considered late, et cetera, et cetera. So that is one of the most important documents to have. I would say that and the securitization instrument are probably the two most important documents a borrower is going to sign. So make sure that they are accurate and legal. Now, all of this might sound like a lot. I fully believe that when you're learning anything new, it's going to feel like you're drinking from a fire hose. So what I wanted to do here was present a couple different ways that you could invest in private lending, but maybe you don't have to go out and find a borrower yourself. You don't have to do all the due diligence. Maybe you want to start somewhere a little more passive, and then potentially as you kick the training wheels off, then you can kind of move to building something where you're originating. So I just made this little triangle diagram for you. So at the bottom is going to be the most active forms of investing in private lending. The first one is going to be what I call originating and funding. So you are out there looking for borrowers, you're analyzing the deals, you're drawing up all the paperwork, you're making sure the loan goes to closing, everything's run appropriately. The next stage up, something a little more passive from that, will be a model what I call brokering. So for example, you could find someone that you, again, know, like, and trust, find someone that you want to work with and have them find the borrowers, do the due diligence, potentially draw up the documentation. Brokering is a very wide field. There's a spectrum to, like, I've just introduced 2 people and you guys carry on all the way through. We do everything. The only thing you have to do is send money to the title company. So if you're interested in getting started in private lending and wanting a little bit more active role, but not necessarily being the person that's pulling all the levers and trying to figure everything out, brokering might be a good option. And then what I would consider the most passive or least active way of investing in private lending would be through a debt fund. So if you're familiar with real estate syndication, if you've heard that term, You've probably heard that term in the scope of buying an asset, buying multifamily, self-storage, mobile home park, anything. The debt fund is basically the same thing as a real estate syndication. They often use the 506 route for exemption with the SEC to raise investor capital from passive investors. And in that capacity, you are putting in a certain amount of money into this debt fund, beholden to the documents. There's usually what's called a private placement memorandum, potentially an OM, an offering memorandum, depending on the type of fund that it is. And then there's a subscription agreement. So there's going to be a couple different pieces of paperwork you're going to want to pay attention to, because it's going to outline what they can do with your money, when you can get your money back, how you get your money back. Is it coming in tiered? When are you going to get distributions? How frequently do you get notification? All of those legal things should be outlined in those legal documents. Like I said, the PPM or the subscription agreement at minimum should be outlining those. With a debt fund, instead of having your capital backed by a loan, like in the first two possibilities, in a debt fund, you're actually buying shares of an LLC. And then that LLC, depending on the business model of the debt fund, is actually the lender of record. So as long as you understand, while you're investing in debt, what you're technically buying are shares of an LLC that's then going to use that money to go and be a lender of record somewhere for the deals like we've been talking about. That would be kind of the difference. And that potentially could come with some tax consequences. So I am not an attorney. None of this is legal advice, financial advice, tax advice, but that might be something to talk to those individuals about to make sure you understand the difference between these three different models if you're thinking about getting into private lending from a tax perspective. And then this is something I've actually been asked about multiple times lately. So I thought, okay, let's put this out there. So what you could do is create what's called a lending club. This is going to be different than a debt fund. So a lending club might be for a group of people. Maybe you single-handedly don't have $200,000, but maybe 4 people with $50,000 come together and they form a lending club. I'm just going to call it an LLC, but it could be any business entity. I just say LLC because 9 times out of 10, that's what it ends up being. But you could form a lending club. So you're pooling capital together with friends and family and investing it for some purpose. Doesn't necessarily have to be lending, but since that's the focus of this talk, it could be to buy a rental, buy a short-term rental, whatever it is. But basically, the group is coming together and making active decisions about the parameters for the investment. They're controlling where your capital is going in, time frame, person, property, whatever it happens to be. That lending LLC will be the lender of record. The loan is actually the asset for that LLC. So the cash flow will come into the LLC bank account, and then it can be split amongst the members of that LLC, the lending club LLC, based on what everybody has negotiated and signed to on the operating agreement, which is one of the documents you're going to need to get your LLC or your business in general off the ground, because that's going to outline the members, the ownership, how distributions are made, when distributions are made, what percentage, et cetera, et cetera. And then generally, it's going to allow for smaller amounts of capital to get diversified. So even if you are someone that has $200,000, potentially if you come and form a lending club LLC with somebody, if you have multiple people bringing in $100,000 to $200,000, that money can now be diversified over multiple borrowers, multiple properties, instead of just having one lender with their $200,000 involved in one property. Not that that's not necessarily a bad thing, but it does offer another level of diversification. If for some reason you are someone that has $200,000 and you want to put it to work into private lending, but maybe you're not super comfortable doing that on your own, or you're uncomfortable with the idea of all of that being tied up in one deal, that's a great way to get money diversified across multiple properties. I will advocate that you make one person kind of the point of contact. They don't have to be the sole decision maker, but just one point of contact makes everything run smoother. So the information will flow in and out through your LLC through this one person, and then the LLC members can make their decisions on investment and moving forward. And the nice thing about this is accredited versus non-accredited does not matter. What you might have seen for real estate syndication or even debt funds is the accredited versus non-accredited status tends to be very upfront. You know, for example, a lot of the multifamily properties, they can even post their deals online or talk about it publicly unless it only allows accredited investors. If you don't know what accredited versus non-accredited is and you're still interested in private lending, you can look it up on the SEC website, but for the most part, it's not going to matter unless you are interested in doing a debt fund that requires accredited versus non-accredited. And this is just a little picture of what the private lending club could do, your little lending LLC. The A, B, C, and D are the different members. The circles are different sizes because not everybody has to contribute the same amount. So if you have someone that has 200,000, someone else that has 50, someone else that has 40, someone else has 100, you can all come together and pool the capital and then make the distributions according to how everyone agrees to in the operating agreement. From that lending LLC, again, you can invest in these different offerings in the same way as if you were an individual. There are some rules about debt funds for accredited versus non-accredited if you are going into those debt funds as an LLC. So just pay attention if you're interested in doing that as a lending club LLC, that they might have some requirements that every member of the LLC has to be accredited if you're going to be investing in a debt fund that's only for accredited investors. And then I just put together a quick example for a lending club investment. So 4 friends pool together 25,000, 35,000, 50, and 65,000. So they have a total of 175,000 to lend out. Just for this example, I'm going to say they want to use the broker model. So they want someone to kind of help originate the deal, find the deal, do some due diligence, maybe draw up the paperwork and do a lot of the stuff for them. And then they're going to bring the capital. So the broker has found a loan for 168,000 for 12% annualized interest. What's going to happen is the LLC wires the funds to closing after the due diligence period has been done in preparation for closing. The LLC can get set up with a loan servicing company, which is what I do personally with TC Capital. We set people up with our loan servicing company, and they actually will handle the collection of payments, and they will do the direct deposit into whatever bank account is put in on the onboarding paperwork. And then monthly, $1,680 is deposited into the operating account for that LLC. And then according to your operating agreement, what everyone's agreed upon, that can then be split up according to membership. Maybe it's going to be held so you guys can reinvest, whatever that is. That's all handled at the operating agreement at the company level. So that would be a way to get some monthly income coming in through private lending, but not necessarily, like I said, starting off with 200,000, or if you want to be diversified, even if you do have the 200,000. And then here's some ways to keep in touch with me. I love talking about private lending, as you've probably seen. That's my email address up on the top, so feel free to reach out. And then I actually have created a nice little handout. It's super simple, 10 ways to protect your money as a lender. So I know this is a lot of information. Watch it a couple times if you really need to, but that handout is there and available on the website at that link provided. Like I mentioned, I run a free Facebook community. It's called Private Lending Lessons. I'd love to have you come be part of the community. We do more education in that community as well. And then if you are on LinkedIn, feel free to connect with me on LinkedIn. I do a lot of posts and a lot of conversation on LinkedIn as well. So I hope you have learned something new from this. And if you have any questions, feel free to reach out. I always love talking to people about private lending. So thank you for your time, and I hope to see you at a future event.